Welcome back to the Deep Dive. It is Tuesday, February 10th, 2026. Today, we are looking at a company that, is often seen as just a place to sleep, but judging by the earnings report that dropped this morning, it's acting a lot more like a barometer for the entire global economy. We are looking at Marriott International. And considering the stock, MAR, is up over 9% today. Trading around, $361? The market clearly likes what it sees.
Oh, they certainly do. And it's interesting because, usually hospitality earnings are pretty standard. Occupancy is up, occupancy is down, that sort of thing. But this Q4 and full year 2025 report, it's different. It's painting this really complex picture of where the world is putting its money right now.
Yeah, it feels less like a hotel report and, more like a masterclass in financial engineering. I've been going through the transcript with CEO Tony Capuano and the outgoing CFO, Leanie Oberg, and the headline, number revenue coming in at $6.69 billion. I mean, it's solid, but that's not really the story, is it? Because when you look at the actual travel habits, there's this massive disconnect between what's happening here in the U.S. and what's happening everywhere else.
That is the first big takeaway. It is absolutely a tale of two markets. On a global level, RevPAR, that's revenue per available room, it's up nearly 2%. But if you isolate the U.S. and Canada, growth has effectively stalled. In the fourth quarter, it actually dipped into negative territory, down 0.1%.
Which, on the surface, that sounds like a recession signal, but
Yeah.
we have to contextualize that with, the chaos we saw in Washington late last year. The report was very specific about the government shutdown.
Right. The 43-day shutdown, we knew it was disruptive at the time, but this data here, it just quantifies the damage. Marriott's government RevPAR plummeted over 30% during that period.
30%. That is a staggering drop. And it's not just the 43 days the government was closed, right? It's the hangover effects.
Precisely. Even after the lights came back on, government travel remained down about 15%. And that just drags down the entire business transient sector in North America. It just goes to show you how much of the domestic hotel industry is actually underpinned by public sector movement. When the government freezes, Marriott catches a cold.
And this has to be why the stock is up. The rest of the world didn't get the memo. While the U.S. was paralyzed by politics, international markets were just sprinting.
Sprinting is exactly the right word. International RevPAR was up over 6%. You looked at the UAE, up 17%. Japan, India, Australia, all of them posting double-digit growth. This is that decoupling we've been waiting to see. The global consumer, specifically the cross-border traveler, is still incredibly bullish on experiences.
It completely offsets the domestic weakness. But there's another layer to this divergence. It's not just where people are traveling, but who is traveling. I noticed a pretty sharp divide between the luxury segment and, say, the budget options.
That's the wealth gap playing out in real-time hospitality data. The select service tier, which is your courtyards, your Fairfield Inns, that kind of thing, that actually saw decline. Would suggest the average consumer is feeling the pinch of inflation, maybe tighter credit. They're pulling back.
Meanwhile, the luxury tier, your Ritz-Carlton, your St. Regis, they're doing just fine.
Better than fine. Luxury RevPAR was up over 6% for the year. The high net worth individual is not trading down. They are prioritizing these high-end experiences over, buying more goods. And Marriott knows this, which is why their pipeline is so heavily weighted toward these high-margin properties like a new St. Regis in Aruba.
Speaking of the pipeline, the sheer scale of this company is getting hard to wrap your head around. They're closing in on, 1.8 million rooms globally? But what struck me wasn't just the size, but how they're getting bigger. They aren't just pouring concrete for all of these, are they?
No, and that is a crucial distinction for their business model. Construction is slow, it's expensive, it's capital intensive. If Marriott relied only on building new hotels, they couldn't possibly hit these growth targets. The magic word here is conversions.
Which is essentially just plugging an existing hotel into the Marriott matrix.
Correct. You take an independent hotel or a property that's flagged with a competitor, and you just bring it into the Marriott system. In 2025, conversions accounted for about a third of all their signings.
That makes so much sense from a speed perspective. You don't have to wait for permits or construction crews.
Speed to market is the entire advantage. 75% of these conversion rooms start paying fees to Marriott within 12 months. You compare that to a new build, which can take years. It's an immediate cash flow injection.
But it's not always a win. I did see they finally pulled the plug on that Sonder agreement. That was the apartment-style experiment, right?
It was, and that exit is really telling. Sonder was supposed to be a way to compete with Airbnb, but the economics just didn't work. So Marriott terminated the deal took the charge, and moved on. It shows they're disciplined, they're willing to prune the portfolio if a concept isn't delivering, even while they're aggressively expanding with brands that do work, like City Express in Latin America.
So they're cutting the dead weight and doubling down on the winners. Okay, let's get to the real engine here. We've talked about rooms and RevPAR and geography. But if you read deep into the 2026 outlook, the most shocking number isn't about hotels at all. It's about credit cards.
This is where the business model shifts from hospitality to something closer to fintech.
They are projecting an approximate 35% increase in co-branded credit card fees for 2026. 35%. That is massive.
It is the single most important data point in the entire report. I really believe that.
So explain the mechanics of that for us, because that's not just people buying more club sandwiches at the pool.
No. This revenue flows into their franchise fees line, but it comes from the banks. JP Morgan Chase, Amex, Marriott charges them for the royalty of using the brand and issuing Bonvoy points. A 35% jump suggests they've renegotiated terms or maybe hit some volume triggers that are drastically increasing the payout.
So in a way, the hotels are just the customer acquisition channel.
Yeah.
You stay at the hotel, so you sign up for the card, and then you use that card to buy groceries and gas, and Marriott gets a cut of everything.
Exactly. The loyalty program Marriott Bonvoy now has 271 million members.
Yeah.
They added 43 million people last year alone. I mean, that is a database larger than most countries. And by logging those people into the credit card ecosystem, Marriott monetizes their spending 365 days a year, not just the 7 days they are on vacation.
It really reframes that luxury resilience we talked about earlier, doesn't it? If you have a customer staying at a Ritz-Carlton Reserve, that is a customer with a high credit limit and, a very high monthly spend.
And that is the exact customer the banks are desperate to acquire. Marriott is the gatekeeper. So when we see that 35% fee hike, it's a signal that the loyalty program is likely generating higher margins than the actual operations of the hotels.
It's brilliant, really.
Huh.
The hotels are the hardware, but Bonvoy is the software that runs the money. But to keep that software running, to keep those 271 million members engaged, they have to control the booking experience. And that brings us to the tech investment.
Right. If people book through Expedia or Booking.com, Marriott loses data and they have to pay a commission. They need direct bookings.
And their answer to that is, predictably, AI. But I'm always skeptical when legacy companies start throwing around buzzwords. Tony Capuano talked about natural language search launching in the first half of this year. Is this actually a functional upgrade, or is it just another chatbot?
Well, in this specific use case, it could be a significant defensive moat. Think about how search works now. You filter by date, price, location. It's rigid.
Very rigid, yeah.
Yeah.
If I want a quiet hotel near a park with a good Italian restaurant, the current filters are useless.
Exactly. And that is where Google usually wins. But Marriott is deploying this AI search, and they're partnering with Google and OpenAI, by the way, to keep that query on their own platform. If you can type that complex request directly into the Marriott app and get a tailored result, you never need to leave their ecosystem.
So it's all about retention.
It's about shortening the distance between inspiration and transaction. If the AI acts as a concierge, the conversion rate for booking goes up, and every direct booking saves them money on those commissions.
Yeah, it makes sense. If you are going to be a tech-enabled loyalty company, your app actually has to work.
Yeah.
Okay, looking ahead. We are in February 2026. The guidance for the year predicts net rooms growth accelerating to around 5%. RevPAR growth is modest, 1.5 to 2.5%. But there is a massive catalyst looming this summer.
The FIFA World Cup.
It's finally here. North America.
Yeah.
16 host cities.
And Marriott is everywhere. They have hotels in every single one of those markets. They've explicitly called this out in the guidance. They're expecting it to add 30 to 35 basis points to global RevPAR.
Wow. That is a huge bump from just a single event.
It's a tangible, unavoidable demand surge. You have teams, media, sponsors, and millions of fans. Unlike the government shutdown, which removed demand, this is a guaranteed injection of high-yield compression nights.
It's interesting to see them quantify it so precisely. It just shows how much data they really have. Before we close out, I do want to mention the human element here. This was Leanie Oberg's final earnings call as CFO.
It was. And she has really been the financial architect behind a lot of what we've just discussed today. The Starwood merger integration, the post-COVID survival strategy, and this big shift toward asset-light growth.
And that shift is really the summary of this entire deep dive, isn't it? Marriott isn't trying to be the biggest builder of hotels. They're trying to be the biggest manager of travel demand.
Correct. They returned over $4 billion to shareholders in 2025. They're planning to return another $4.3 billion this year. They can only do that because they aren't tying up all their cash in real estate. They're an asset-light, fee-generating machine.
Which leaves us with a pretty provocative thought to chew on. When you look at Marriott today, with the credit card fees skyrocketing, the AI search, this massive loyalty database, are we even looking at a hospitality company anymore?
That is the question. The buildings are necessary, sure, but the real value seems to have migrated to the data and to the financial ecosystem. In a digital world, the customer profile, the Bonvoy account, might actually be worth more than the suite they sleep in.
The hotel room is just the user interface for the credit card.
That is a cynical but perhaps an accurate way to put it.
Well, on that note, we will wrap it up. A fascinating look under the hood of a company that is successfully navigating a very, very weird global economy. Thanks for checking in with us on the deep dive.
Always a pleasure.